Lots of interesting things are happening in the world economy right now, and by saying that they're interesting is putting it lightly. One of the most interesting things I'm observing right now is the decoupling of a very long-term relationship between the price of gold and the price of oil. It remains to be seen whether or not the old relationship will reassert itself, but there appears to be a fundamental change afoot. I've already discussed it somewhat in my video, GOR as a signal is temporarily broken, but I wanted to discuss it in more detail now because I've been thinking about it quite a bit. Let's start the discussion by setting the table. The LBMA, or London Bullion Market Association, is the hub through which most of the world's precious metal trading takes place. To highlight the sheer volume of trading that occurs on the LBMA, one can take a look at the LBMA Gold Turnover Survey published in 2011. The LBMA is not an exchange, but rather a group of members of an association. Thus, they have no requirement to report turnover or publish statistics, but they did so in 2011. The only previous surveys were published by the Bank of England in 1991, 1994, and 1996. In the survey, the management committee of the LBMA states their intention for conducting the survey as being to provide evidence to the Basel Committee on Banking Supervision that gold should be considered as a high-quality liquid asset so that it can be included in the liquidity buffers that banks must meet. Let me say that again. The intention for conducting the survey is to provide evidence to the Basel Committee on Banking Supervision that gold should be considered as a high-quality liquid asset so that it can be included in the liquidity buffers that banks must meet. Very interesting. Anyway, the management committee reached out to their 56 full members and asked that they provide clearing statistics to be included in the report on the condition that anonymity be preserved. Out of the 56 full members, 36 of them responded with statistics for clearing volumes for the first quarter of 2011. The volume of transactions was simply amazing. If we eliminate double counting by not lumping together sales and purchases, we can see that if the volume is annualized, it works out to be 22.4 billion ounces of gold changing hands yearly. This was roughly 4 times the total above-ground stock of gold at the time, which stood at 5.5 billion ounces, and the total value of that at that market prices at the time was $30 trillion. And this was with only a little over half of the members providing data. So all in all, the total volume conducted on the LBMA could be twice what is shown here. It's an astounding amount of gold changing hands, and it does highlight, as the LBMA desired, just how liquid and how desired gold is. I will revisit these numbers later in the presentation. Just keep them in the back of your heads for later. Another thing I would like to mention now are the 14 market makers of the LBMA. These are Goldman Sachs, HSBC, JP Morgan, UBS, Bank of Nova Scotia, Barclays, BNP Paribas, Citibank, Credit Suisse, Merrill Lynch, Morgan Stanley, Societe Generale, Standard Chartered, and Toronto Dominion Bank. Many of these banks are running into significant difficulties right now with regard to their stock valuation, and some, most notably Credit Suisse, are seeing their credit default swaps start to increase very noticeably. Again, keep this in the back of your mind because it will be important later. Now let's take a look at the gold-to-oil ratio, or GOR as I like to call it. Here are our monthly ratios going back to the year 1968. As can be seen, and as I've often noted, the GOR has tended to stay between a range of 10 and 25. At values close to 10, gold could be seen as cheap relative to oil, and at values close to 25, it could be seen as expensive, again, relative to oil. Occasionally the GOR would rise above 25, and even above 30, but when it did, it would not stay there for very long. The GOR, while not being perfect all by itself, could serve as one valuation metric for gold. When taken in conjunction with other signals, it was pretty useful. Now you probably already noticed that something interesting is happening on the right-hand side of the chart, but just to highlight the unusual behavior, I'll put 2 lines on the chart, one at 10 and the other at 30. we can see that the gold to oil ratio, which is now well above 40, is exhibiting behavior not seen for the last 45 years. One could say, so what? 45 years is not a very long period of time. Yes, I'll admit that. One of the reasons I tend to go only back this far is that the dollar was tied to gold until the year 1971. That said, if we use the fixed dollar value of gold before 1971, we can show how the gold to oil ratio behaved going back for 150 years. So let's do that. The data I have for oil prices is quite a bit more sparse before 1968, but I do have some yearly numbers that can be used to construct the gold to oil ratio going back to 1870. One can see that the ratio has been very stable. Most of the data fell between 10 and 25, and a few of the data points were as high as 30, but very few of them exceeded 30, and when the ratio did exceed 30, it did not stay there for long. Either the price of oil increased or the price of gold decreased until a more normal ratio was reestablished. But now we see that the current gold to oil ratio is higher than it has been for the roughly century and a half that oil has been used as a fuel. Sure, it was pretty high during 1891 through 1911, again from 1932 to 1946, once again in the year 1973, and also in the years from 1986 through 1998, but never this high. Something has changed. If the old relationship reasserts itself, we should see the price of oil go up significantly or the price of gold go down significantly. I don't think the former is likely to happen, given the current glut of oil on the market. It will take some time for fracking companies to default on their now junk debt, enter into bankruptcy, and stop producing oil. It's equally unlikely that gold is going to go down in price significantly. As I showed in my GOR as a signal is temporarily broken video, the gold miners are having trouble making profit here. In addition, the system of world currencies is under severe stress right now, and fear is in the air, and for good reason. So, if the GOR is likely to be unreliable from now until the world financial system resets, what should we use as a guidepost? Well, one thing the GOR ratio does not tell us is whether or not the dollar is overvalued. All it tells us is how gold is priced relative to oil. If we want to evaluate the dollar, the best way to do so is to compare the total debt owed by the U.S. Treasury to the value of gold that it claims to have in storage. That'll give us a better idea of how the dollar price of gold is going to move, because it's really the dollar that's changing in value. So let's look at that chart now, as we have done in the past, and see if there are any interesting developments. Here we can see the ratio of Treasury debt to the market value of Treasury gold going back to the year 1875. Note that the scale is logarithmic, and so there's a very meaningful difference in some of the extreme data points. Many of the big changes were order of magnitude changes. Now, I'm not going to go into great detail regarding the history behind some of these moves. I've done that a few times already in past videos. I only want to mention here that the low points on the chart were times when the world had little confidence in the dollar and U.S. Treasury debt, and the high points were times when the world had a lot of confidence in the dollar and U.S. Treasury debt. If I label the extremes, you'll be able to see what I mean. In 1916, when World War I was taking place, even though the U.S. wasn't involved until 1917, no Western nation had significant funds to lend. It was all used for warfare, and so the U.S. was not able to borrow much more than it had gold in the Treasury. But after the war, with the Allies victorious, the world was eager to lend the U.S. funds because it was a manufacturing powerhouse. The U.S. was able to borrow about 10 times the value of gold in its vaults. But then, over time, especially towards the end of the Great Depression, the world was not willing to lend the U.S. more than about twice the gold that it had in storage. Of course, with World War II in progress at the time, the Western nations again didn't have much in the way of funds to lend. In addition, since the U.S. was running a surplus by selling munitions to warring nations, it was attracting a great inflow of gold, which further reduced its leverage. Then we went on a 3-decade spree of spending that culminated with the Vietnam War and LBJ's guns and butter programs. We reached a point where U.S. debt was 33 times the value of gold held in storage, and the nations of the world started cashing in their currency for gold until Nixon closed the gold window. Confidence in the dollar gradually waned until 1980. Yes, it's true that gold could not be drained from the Treasury, but the dollar could be marked down in value, and it was marked down severely during the inflationary 70s. But then a funny thing happened in 1980. The US debt started to balloon again, and the currency did not lose value relative to gold. This was quite odd. Leading up to gold's peak in 1980, it looked like confidence was going to be completely lost in the dollar. The price of precious metals skyrocketed as many, especially the oil states, frantically sought to convert their dollar currency to gold on the open market. Now, some credit Paul Volcker having raised short-term rates into the teens in 1980 with the saving of the dollar. And while I think it helped, I do not think that that was the whole story. Let's discuss what else changed from a fundamental standpoint. I'll give you a hint. It has to do with the first topic that we were discussing in this video. That's right, the emergence of a financial derivatives market. While agricultural futures had been around for a while before 1980, financial futures contracts did not become prominent until the late 1970s. Let's add some detail to show how the use of derivatives could have turned the tide in 1980 and caused the ratio of U.S. debt to its gold to increase rather than reverting to the 1.5 or 2.0 that it had seen in 1916 and 1940. Using some historic mining data I have available, I estimate that in the year 1971, there was about 2.7 billion ounces of total above-ground gold in the world. This gold did not circulate quickly. With no currency redeemable in gold in 1971, it could not change hands quickly. The currency could change hands, but in order to move a significant quantity of physical gold, the physical gold itself had to be moved. And gold, as we know, tends to be very tightly held, and so it won't have a very high velocity of circulation. Over the 1970s, about 500 million ounces of gold was added to the total above-ground stock. But again, it couldn't change hands quickly. It had no mechanism to do so. The physical gold was held very tightly. The derivatives market in financial instruments and gold was still very young at the time, and so gold did not change hands readily. This was one of the reasons why gold skyrocketed in price in the late 1970s. Big oil money was bidding for gold in the open market, and since not much gold was offered, the price rocketed up. In a sense, this was a devaluation of the dollar against gold. Now look at how things have changed leading up to the year 2011. The above-ground gold stock was 5.5 billion ounces. Without the financial derivatives market, this gold would not change hands quickly. However, as we can see from the LBMA statistics, 36 of the 56 LBMA members traded 22.4 billion ounces of gold on an annualized basis. If we include the non-reporting members, the annual volume could have been as high as 8 times the above-ground stock of gold. This is a huge increase in the availability of gold to absorb dollar demand. It's very similar to a credit market making credit much more available. If expanding credit cheapens the dollar, then expanding gold derivatives will do the same for gold. Gold derivatives are to gold as dollar-denominated credit is to the dollar. It was the rapidly expanding derivatives market that kept gold weak in the dollar, and this is what prevented the point shown in the year 1980 from reaching the lows seen in 1916 and 1940. Now, imagine if it was the derivatives market creating false supply and velocity which kept gold weak in the dollar. What will happen if faith in the derivatives market deteriorates? All that's really required to change the current trend is for the derivatives market to fail to expand. But what if it fails altogether? Well, best case is that we reach the point seen in 1980 of 5.6. This would imply a gold price that is more than 10 times what it is today in dollars. That is, assuming U.S. debt does not continue to expand any further, which is a fairly dubious assumption. Now, worst case, the ratio will reach a point somewhere between 1.5 and 2, which would imply a gold price that is a factor of at least 25 times higher than today. Again, assuming that the debt of the U.S. ceases to expand. But what on earth could possibly cause those who currently use the precious metals derivative market to lose faith in it? I'm glad you asked.